Today, we are going to explore a very interesting options plan called the long box. This strategy is designed for a specific type of market condition. It works best when a stock price is not moving much at all. Imagine a stock trading sideways, staying within a predictable price range. This is what we call a neutral market. The long box aims to make a profit from this lack of strong direction. It is a way to trade when you believe the market will remain calm and quiet. This strategy is not for traders who expect big dramatic price swings up or down. The long box has another important feature. It works particularly well when the market expects big price moves, but those moves do not happen. This expectation is called high implied volatility. When implied volatility is high, options become more expensive. The long box uses a combination of buying and selling options to take advantage of these prices. Your potential profit is capped, and your potential loss is also capped. You know your maximum risk and reward before you even enter the trade. The long box strategy is built using 4 different option trades. These are all on the same underlying stock, and they all share the same expiration date. The combination creates the unique payoff profile of the box. The order in which we list them helps you see how the position is constructed. First, a short put. When you sell a put, you receive a premium and take on the obligation to buy at the strike if exercised. Second, a long call. You pay a premium for the right, not the obligation, to buy at its strike. These first 2 legs often form a synthetic long stock position. Third, a long put. You pay for the right to sell at the strike, helping protect against downside moves. Fourth, a short call. You receive a premium and take on the obligation to sell at the strike if exercised. The long put and short call combine into a synthetic short stock position. Together, you are buying synthetic stock and selling synthetic stock at different prices. The sold options bring in cash, the bought options cost cash. The difference is the net cost, or net debit, of the trade. A very important number. One of the most appealing features is clearly defined risk and reward. Before placing trades, you can calculate the absolute maximum you can make and the absolute maximum you can lose. This is a capped risk and capped reward profile. Knowing these limits provides peace of mind. Maximum profit is the difference between the 2 strike prices minus the net cost you paid. If strikes are 145 and 155, the difference is 10 per share. With a net cost of 8 per share, max profit is 2 per share, realized if price closes between the strikes at expiration. Your maximum loss is the net debit you paid. In our example, $8 per share. Below the lower strike, loss is flat. Above the higher strike, profit is flat. Between them, the line rises toward max profit. This shape is why it is called a box spread. You will never face a surprise unlimited loss with this strategy. Unlike more speculative trades, volatility is a key concept in options trading, and it plays a very important role here. Volatility measures how much a stock is expected to move. When volatility is high, the market anticipates large swings. Options become more expensive. Both call and put prices rise as implied volatility rises. When you set up a long box, you both buy and sell options. High IV raises your buy costs, but it also increases the premiums you collect on the shorts. The goal is a favorable net entry. If volatility decreases after entry, the position can gain in value. This is being short Vega. Your sold options typically lose more value than the ones you bought, creating a net gain. You can potentially close for profit before expiration. Enter during high anxiety, like pre-earnings. If the move is mild, IV often collapses, ideal for a long box. Enter when options are expensive from uncertainty. Exit when they become cheaper as the market calms. To bring these ideas together, let's walk through a detailed example using Procter & Gamble. We will use simple, round numbers. Imagine today is November 17, 2025, and P&G is trading at $150 per share. We believe it will stay in a range for the next month, and IV is high due to an upcoming investor day. We choose two strikes that create a box around price, 145 and 155, expiring in about 1 month. Each contract typically represents 100 shares. Assume these premiums per share are available. First, sell the 145 put, receive $3 per share. Second, buy the 145 call, pay $7 per share. Third, buy the 155 put, pay $6 per share. Fourth, sell the 155 call, receive $2 per share. Credits and debits. Selling is credit, buying is debit. 3 minus 7 minus 6 plus 2 equals minus $8, a net debit of 8 per share. One contract equals $800 cash outflow. We have built the long box on P&G with known costs and defined outcomes. Now that we established our P&G long box and know it cost $800, we can calculate maximum profit and maximum loss, the core of risk management. Max gain equals the difference between strikes minus the net debit. With strikes at 155 and 145, the difference is $10 per share. Net profit is 10 minus 8 equals $2 per share. For one contract, that is $200. Maximum loss equals the net debit you paid. In our example, $8 per share, or $800 per contract. You cannot lose more than the initial amount invested. So, max potential profit is $200, and max potential loss is $800. The risk-to-reward ratio is 4-to-1. Traders must decide if that ratio fits their plan. A higher probability of profit can justify a less favorable ratio in some cases. The key is that you have all this information up front. With fixed figures, there are no surprises at expiration regarding best and worst case scenarios. Placing the 4 trades needs care to avoid problems. Ideally, enter as a single transaction using your broker's multi-leg order tool. Select short put, long put, short call, and submit as one box order. This executes all 4 legs at the same time for a specified net price. Prep. Confirm a neutral sideways view and that implied volatility is high enough. Choose your strikes carefully, for our PG example, 145 and 155, and ensure the same expiration date. Use a limit order at your acceptable net price to avoid bad fills. Never use a market order for a 4-leg strategy. If your broker lacks combo orders, separate entries are riskier due to partial fills. If necessary, enter as 2 vertical spreads. First the 145 call put spread, then the 155 call put spread. Plan the exit as clearly as the entry. You can lock in profits or cut losses. You do not have to hold to expiration. Best method, do the exact opposite. Buy back what you sold, sell what you bought, in a single multi-leg order. If you bought the box for an $8 debit and later sell it for a $9 credit, profit is $1 per share, or $100 per box, minus commissions. Alternatively, close in pairs. First the bull call spread, long 145 call, short 155 call, then the bear put spread, long 155 put, short 145 put. This offers flexibility, but risks one spread moving against you while closing the other. Set a profit target. If you reach about 50% of maximum profit before expiration, consider taking the win. Set a stop loss. If losses hit your limit, or implied volatility moves sharply against you, close to prevent bigger losses. Avoid the final week to reduce early exercise risk on the short options. Usually, closing all 4 legs together keeps the position balanced until the end. A note on taxes and key risks to consider. Profits from a long box are typically treated as capital gains. It is a capital gain strategy, not an income strategy. Tax rules vary by country. Consult a qualified tax advisor and keep accurate records. Major operational risks include partial fills when you cannot place a single combo order. Early exercise on American-style shorts can force stock transactions and disrupt your position. This risk increases as short options go deeper in the money. 4 legs mean more fees for entry and exit, which eat into profits. Selling options requires margin. Brokers will reserve capital for short legs. In summary, a long box is built by selling a put, buying a call, buying a put, and selling a call, in that order, on the same stock and expiry. It suits a neutral, sideways market and benefits from high initial implied volatility that may fall. Both risk and reward are capped and known in advance. Enter with a single box order when possible. Exit by reversing all 4 legs. Always be mindful of partial fills, early exercise, and transaction fees. Learn the rules, consider paper trading first, and remember, options involve substantial risk and are not suitable for every investor.